Hi PipBuddies, welcome back to the channel. If you've been around trading communities for more than 5 minutes, you've probably heard this debate. Some traders swear by indicators, others say they're useless and you should throw them all in the trash. The truth? Indicators are just tools. They're not magic, they're not evil, and they're definitely not a replacement for reading price action. But when used correctly, the right indicators can sharpen your analysis and help you make smarter decisions. So today, we're going to be cutting through the noise and looking at 3 indicators that actually deserve a spot on your chart: moving averages, RSI, and MACD. We'll cover what they do, how to read them, and how to use them without turning your chart into a messy rainbow of conflicting signals. There are hundreds of indicators out there, from the classics that have been around for decades to newer, custom-built ones that promise to predict the future. But most traders don't need a complicated setup to be effective. You just need a few reliable tools that give you clear, useful information without slowing you down. Moving averages, RSI, and MACD are popular for a reason. They're simple, they work across markets and timeframes, and they're versatile enough to use in both trending and ranging conditions. Most importantly, they help you confirm what the price is already showing you, instead of distracting you with conflicting signals. Let's start with moving averages. If raw price action is like listening to a live concert with all the crowd noise, a moving average is like putting on noise-cancelling headphones so you can hear the music clearly. A moving average takes the average closing price over a set number of periods and then plots it as a smooth line on your chart. A simple moving average, SMA, treats all periods equally, while an exponential moving average, EMA, gives more weight to recent prices, making it more responsive to current moves. You can use moving averages in different ways. One is to spot the overall direction of the market. If price is consistently above the moving average and the line is sloping upward, you're in bullish territory. If price is below it and the line is sloping downward, you're in bearish territory. Another way is to look for moving average crossovers. For example, when a short-term EMA crosses above a long-term EMA, it can signal that momentum is shifting to the upside. But here's the key. Moving averages lag behind price because they're based on past data. That means they're better for confirmation than prediction. Don't use them to guess where the market will turn. Use them to see where the momentum is already flowing. The Relative Strength Index, or RSI, is like a thermometer for market conditions. It measures the speed and the size of recent price movements to tell you whether an asset might be overbought or oversold. RSI runs on a scale from 0 to 100. Traditionally, readings above 70 suggest that the market is overbought and might be due for a pullback, while readings below 30 suggest it's oversold and might bounce. But here's where context comes in. In a strong uptrend, RSI can stay above 70 for a long time without reversing, and a strong downtrend, it can stay below 30 for much longer than you might expect. This is why RSI works best when you combine it with support and resistance or trend analysis. An oversold RSI at a strong support zone means a lot more than an oversold RSI in the middle of a downtrend. It's not just about the number, it's about where it happens on the chart. RSI can also be used to spot divergences. If price is making higher highs but RSI is making lower highs, it can be an early warning that momentum is fading and a reversal could be coming. The same applies in reverse for bullish divergence. Now, that's a lot. But finally, let's talk about MACD, the moving average convergence divergence indicator. It sounds complicated, but it's really just a way to measure the relationship between 2 moving averages and how quickly they're converging or diverging. MACD has 3 components: the MACD line, the signal line, and the histogram. The MACD line is the difference between 2 EMAs, usually the 12 period and the 26 period. The signal line is a 9-period EMA of the MACD line. The histogram shows the distance between the 2 lines, making it easier to see when momentum is picking up or slowing down. Traders often look for MACD crossovers where the MACD line crosses above the signal line for a bullish signal or below it for a bearish one. They also watch for the histogram to move from negative to positive or vice versa, which can confirm shifts in momentum. Like RSI, MACD can also show divergence between price and momentum. If price is making new highs but MACD isn't, that's a red flag that the move might be running out of steam. Individually, these indicators are useful. Together, they can form a powerful confirmation system. Imagine you're looking to buy. Price is above a rising EMA. RSI is around 50 and turning up from a recent dip. And MACD just had a bullish crossover with the histogram moving into positive territory. That's 3 different tools telling you the same thing. And that alignment can give you the confidence to pull the trigger. But remember, indicators should never replace price action. Always start with the chart, identify the trend, mark your support and resistance zones, and then use these tools to confirm what you're already seeing. If the indicators agree with your analysis, great. If they don't, that's a sign to slow down and reassess. One of the biggest mistakes traders make is overloading their charts with too many indicators. If you have 8 different tools giving you signals, you're going to be ending up confused and hesitant. Stick to a small complementary set that you understand deeply. Another mistake is taking every indicator signal at face value without considering the market environment. A bullish MACD crossover in the middle of a strong downtrend is far less reliable than the same signal in a bullish trend. Context always matters. And finally, relying solely on indicators without understanding how they work is a recipe for frustration. Indicators are built on price, and if you don't understand the underlying price movement, you'll end up chasing signals instead of making informed decisions. So there you have it. Moving averages to smooth out the noise and show you direction. RSI to measure market temperature, and MACD to track momentum shifts. Used together and in the right context, these indicators can help you spot high-quality trade setups and avoid some of the most common traps. Now, that was a lot, but in the next video, we're going to be moving into deeper market analysis by combining these tools with real-world chart examples, so you can see exactly how they work in live conditions. If you found this helpful, give it a like, drop a comment with your favorite indicator combo, and subscribe so you don't miss out on the next lesson. Until then, keep your charts clean, your tools sharp, and your analysis clear, because the best trades come when everything lines up.